Hey guys, welcome to the channel, Kylie here. Okay, so for decades, Warren Buffett has been hailed as the godfather of investing. And as one of the richest people on earth and a legend at beating the market, Buffett's strategies are likened to like the holy Bible for investors. And for many years, these strategies have certainly paid off. Over the last 50 years, Buffett's firm Berkshire Hathaway has beaten the market by an average of 10%, and it has amassed an excess of $100 billion. But when you dig a bit deeper, that upward trend appears to have been slowing for some time. So today I'm going to take a look at whether or not Warren Buffett's investment strategies still make sense today. And to do that, I'm going to be taking a look at how Berkshire Hathaway has performed against the market over the last 50 odd years. And I'm going to be taking a look at some of the strategies Buffett used before Berkshire Hathaway when he made his first million. Buffett has always been very public about his strategy, and he's best known for the following characteristics. Number one would be value investing. This strategy looks for stocks that are priced lower than their intrinsic value. In other words, buy low, sell high. Number two would be ignoring market movements. Instead, he opts for a long-term investment strategy where he buys and then he rarely sells.
If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year. And we care a lot about the price. We do not care about the next 12 months.
Okay, third would be invest in companies that you understand. Invest in a company that you understand or that you're passionate about. And Berkshire Hathaway certainly follows these rules. It owns a large number of US blue chip stocks such as Coca-Cola, Kraft, Apple, and American Express. And he's also increased the number of growth stocks added to his portfolio in recent years, although it's significantly less than the blue chip plays. Plus, Berkshire has invested in index funds, specifically the S&P 500 funds, of which, Berkshire itself is a member. By 2020, Berkshire had 87 billion in assets, its biggest number ever, and 2.4 billion in revenue, which is among the top in the US. I think it was number 6 last I checked. So it makes a lot of money. Okay, but let's say you were to apply the same rules and strategies that Buffett always promotes. Like if you had all of Buffett's knowledge about analyzing a good value company, would you eventually build up the same wealth that Buffett has? Well, to work that out, I think we need to look at how he has performed over the last 60 years of his investing career. And an easy way to do this is to look at Berkshire Hathaway's performance. And we know what this is thanks to his annual shareholder letter. So we can see here that Berkshire has outperformed the market by around 10% since the 60s. That's a pretty solid number. But when you look at different time frames, you can actually see that most of these gains were achieved in the early years of Berkshire. For example, this article by Seeking Alpha shows Berkshire's performance over the last 10 years, over the last 1 year and beyond. And it's a really interesting way to see how much he's outperforming depending on the time frame. So you can see here that over a 1 year time frame from April 20 to April 2021, Berkshire has performed at 46.75 versus the S&P 500, which is 45.98%, so pretty much on par. But if you step back a little bit further, you can see in fact that Berkshire Hathaway has underperformed the index by a pretty significant margin of around 20 percentage points. But it's when you go back even further, say over a 20-year time frame, that you can see that Buffett has really outperformed the market. 20-year time frame shows that Buffett has returned 655% compared to the S&P 500 at 311. And in fact, if you keep going back even further, that margin increases substantially. So if you'd invested with Warren Buffett, say in the 60s, you'd have a very nice chunk of capital now, much bigger than say if you'd invested in the S&P 500. But that same trend hasn't really continued in recent years. It's been basically on par for the last 5 years, for example. And 5 years is a pretty big time frame. So if you look here at the shareholder letter from Buffett, he shows every year and the performance of Berkshire Hathaway compared to the market. And you can see that the 1970s and the 1980s and the 1960s as well were great years for Berkshire Hathaway. And they really push up the average by a substantial amount. And you can also see here that when the stock market crashes, Berkshire Hathaway really outperforms. This is when Berkshire Hathaway has shown its true colors. But what is interesting is that this hasn't been the case for the COVID-19 market crash, where Berkshire Hathaway significantly underperformed the market. And instead of buying up companies, as he usually does during a stock market crash, he actually sold down a lot of companies, including banks and airlines. And by doing so, he missed out on some really great returns as those stocks shot up very quickly soon after, especially the banks. The banking sector has been among the best performing sector since the COVID-19 crash. So what about what he was up to before Berkshire Hathaway? What steps did he take to get his first million? So Buffett was born in 1930 in Omaha, Nebraska, to Howard and Layla Buffett. Howard Buffett was a businessman who owned several firms, one of which was a stock brokerage. Warren developed an interest in investing from a pretty young age. In fact, his senior yearbook picture allegedly reads, "Likes maths, a future stockbroker." By the time he was 11, he'd bought his first stock, and he was also very entrepreneurial from a young age, starting up a number of small businesses while he was still in school, from running a paper route to investing in farmland. By the time he was 25, he'd launched his own firm, Buffett Partnerships, with $105,000 and very big dreams. So the performance of Buffett Partnership outperformed Berkshire Hathaway by a pretty large margin, although it was only to last 10 years. During that time, Buffett achieved an annual compound return of 24.5% net of fees. Meanwhile, the annual return of the Dow Jones over the same period, with dividends included, was only 7.4%. So if you'd invested $100,000 in the Buffett Partnership in 1967, a decade later you'd have had $1,719,000 by 1969, when the firm closed. And if you'd invested the same amount in the Dow Jones, it would have only grown to $252,000. It's worth noting here that the strategy that he employed at Buffett Partnerships was broadly similar to Berkshire Hathaway in so much as he looked for undervalued companies to invest in at discount prices, although he took much bigger risks, and it was far more active than passive. And it was pretty shark-like. One of the strategies was to buy out and eventually take over ownership of companies, one of which ended up being, of course, Berkshire Hathaway. So while Berkshire largely relies on the performance of large blue chip companies, Buffett Partnerships picked out a lot more smaller cap stocks, and it had some pretty aggressive strategies in there as well, which included buying out companies and firing their directors, like Berkshire Hathaway. Buffett and Partnerships was incredibly successful during its decade-long tenure. But in the end, Buffett called it quits because he didn't think the strategy he was employing at that stage, essentially buying bargain small caps, would continue to yield strong results moving forward. And that's possibly part of the reason he approached the market in a new kind of way with Berkshire Hathaway, employing the same strategies that he understood and that he stood by, but in a new way, by investing in index funds, by investing in major blue chip stocks overwhelmingly, and employing a much more passive approach. So in conclusion, do Buffett's strategies stack up in today's world, and could you become rich by applying the same principles? Well, it kind of remains to be seen as to whether or not he's still got it. He's admitted before that he doesn't get tech stocks or social media stocks, and that's a pretty important sector to understand in today's age. Some of the more infamous passes on massively popular stocks has been Facebook, Netflix, Google. However, he does own Apple, Amazon, and Snowflake. Buffett admits that he avoids tech altogether because he doesn't understand the industry well enough. That's in line with one of his most famous strategies, which is to only invest in companies you know. But in recent years, especially since COVID-19, this approach has been questioned. By mid-2020, Berkshire Hathaway had underperformed the S&P 500 by around 17%. He's also famously said that he'll never buy cryptocurrency. And in fact, his vice chairman, Charlie Munger, has called Bitcoin disgusting. And in rejecting change, Buffett is essentially sticking to the old safe plays. On the one hand, Buffett's strategy encourages being passive and low risk. He often says to invest in an S&P 500 ETF or fund. But by that same token, investing passively has only been a very small part of what made him wealthy in the first place. After all, it's easy to invest in an index fund if you have millions of dollars. You know you're going to get a pretty good return. But what got him that first million is, I think, the most important part of the story. Ultimately, he was entrepreneurial, he was great at saving money, and he was passionate and deeply curious about the work he did, which in this case happened to be an incredibly lucrative hobby. Also, in many ways, Buffett's approach can't be considered past its prime, or using a fading strategy, because his strategy is universal and enduring. For example, the concepts of time, buying quality businesses at good prices, and compounding, they're key components to his strategy. There's no real way to refute this approach. For example, holding for the long term and allowing compounding to play out, those are solid and obvious stats. It just doesn't mean that you're going to become a billionaire if you use them yourself. There are a lot of things that Buffett did to become a millionaire that did not include being a passive investor. Buffett took a lot of risks, he started his own business, and he started many other businesses too. And it's also worth remembering that Buffett has been questioned many times before. For example, in 1999, around December, during the height of the dot-com bubble, Barron's released an article titled, "What's Wrong, Warren?" And it questioned whether Warren Buffett, who was 69 at the time, had just become an old man who was out of touch with the shiny new internet economy. Point is that Buffett did not buy into the dot-com bubble, he was criticized for it, but he still won in the end. But would I personally invest in Berkshire? Look, probably not. I do have some Berkshire holdings, but I've got a very, very small amount. It was just for the excitement factor of owning Berkshire and for little other reason. In fact, looking at the performance of Berkshire Hathaway over the last decade and how closely it's tracked the market, why not just invest in an S&P 500 index fund, among which are a higher portion of tech stocks, which I'm much more comfortable with.